Good morning, everyone. I'm Wes Burke with Central Coast Lending. Let's skip the headlines and look at what the mortgage backed securities desk is actually paying attention to today. If you've ever read Rob Chrisman's morning commentary, you know the interesting story usually isn't what mortgage rates did yesterday. It's why bond traders think they'll move tomorrow. That's the lens we're using today. Mortgage rates are starting the week around 6.54% for a conventional 30-year fixed. Down slightly from last week, nothing dramatic. But underneath the surface, bond traders are seeing something encouraging. The Treasury market has finally started to settle after several weeks of geopolitical volatility. When Treasury yields stop making big moves, mortgage-backed securities usually become easier to price. That doesn't automatically create lower mortgage rates, but it removes one of the biggest obstacles. Here's today's insider angle. Professional bond desks aren't just watching Treasury yields. They're watching MBS spreads, the extra yield investors demand to own mortgage-backed securities instead of treasuries. When markets become nervous, those spreads widen. Mortgage rates often stay elevated even if treasury yields improve. Recently, spreads have remained stubbornly wide because investors continue demanding extra compensation for uncertainty. That has kept mortgage pricing from improving as much as many consumers expected. The good news? The widening appears to be slowing. That's something secondary marketing departments across the country are quietly watching this week. Here are the 5 things professional mortgage traders will be watching over the next several days. Number 1, inflation. Any sign inflation is cooling helps both treasuries and mortgage-backed securities. Second, oil. Energy prices have been driving inflation expectations for months. Every meaningful move in crude oil immediately gets attention inside the bond market. Third, treasury auctions. Strong demand usually supports lower yields. Weak demand can push rates higher very quickly. Fourth, Federal Reserve communication. Markets are adjusting to a Fed that is providing less forward guidance, increasing uncertainty around future rate expectations. And finally, institutional demand for mortgage-backed securities. That's the hidden variable most consumers never hear about, but it directly affects mortgage pricing. So what does all this mean for loan officers? First, don't overreact to every move in treasury yields. Watch mortgage-backed securities. That's where mortgage pricing is actually determined. Second, continue managing expectations. We're not seeing a major breakout lower in rates yet, but the environment is becoming more constructive than it was a few weeks ago. Third, stay close to borrowers who are floating. If MBS spreads begin tightening while treasury yields remain stable, pricing can improve surprisingly quickly. Those opportunities rarely last long. Here's today's takeaway. The market isn't suddenly optimistic, but traders are becoming less defensive. That's an important distinction. Treasuries have stabilized. Mortgage-backed securities are behaving better. Volatility is easing. If that trend continues and inflation cooperates, we could begin seeing lenders pass through incremental pricing improvements, rather than simply reacting to every geopolitical headline. For mortgage professionals, that's the story worth following this week. Before I go, a quick note. If you're a loan officer looking for more support, systems, tech, marketing, or just someone to run through strategies with, reach out to me at Central Coast Lending. We're building a team that shares intel like this every week, plus provides training on FHA, VA, buy downs, and that MBS awareness I mentioned. It's how you thrive in a market like this. Give me a call and let's talk about raising your game this summer. That's it for today. Have a great week, stay dialed in, and I'll see you next Monday with the latest updates.